Good afternoon. Today is May 11th. This is the second session for our point and figure chart analysis series. Bruce, welcome back.
Good to be back. Thank you.
I thought that we had a great first session. There was quite a few comments that we've got, and it seems like the participants really liked going into kind of like nuances of point and figure chart construction and the count guide. There were quite a few questions, and as I mentioned before, we will address those questions as we go. And it's better to address those, as we look at specific charts. We're talking about specific concepts. So all of the questions I see, and I will come to them at specific points. So we'll definitely address those. Bruce, before we start, I had one of the questions that I received was on where exactly in the process of selection, and by the selection process, I mean the process of selecting a specific stock with the specific Wyckoff characteristics, where in this process point and figures are going to be the most beneficial to a Wyckoff trader. And at what point should we rely on the point and figures in our analysis for the selection of the stock?
Well, kind of a broad answer. There's a couple answers to this. One is that when we use two types of charts. We use vertical charts and we use point and figure charts. And we don't use these charts because they do the same thing. We're not creating redundancy here. We're using point and figure charts because they do a certain thing, and we're using vertical charts because they do another certain thing. Vertical charts are really good for getting into the nuances of how a stock or an instrument ETF index is trading, because we can look at things like spread, volume, we can look at the extent of a move, we can look at whether a move is exceeding a prior move, and what the quality is. Those are all things that are difficult to tell on a point and figure chart. Not that it can't be done, but they're difficult, because point and figure charts actually are designed in such a way that they actually take information out of the charting process. And the function of a point and figure chart is to plot based on volatility. The movement to the right is based on the swings and the volatilities as a stock is unfolding, either an accumulation, distribution, stepping stone, whatever it might be. So in the case of looking at, say, two particular stocks, and or many more than that, but let's say two, and trying to compare them to select the one that might have the greatest potential for an upside move. Well, we would look at the vertical chart, and from the vertical chart we would compare waves. The down waves we would compare. The up waves we would compare. We would compare them for which one is showing the most resistance to decline on the way down. Which one is showing itself to be the most robust on the way up? Which one has the most volume coming in as it's turning up and maybe breaking to new highs? That kind of thing. A point and figure chart we're going to use in a different way. Not that it couldn't tell those things, but it would be a little more difficult to determine them. What we can tell from a point and figure chart is that we can count the horizontal unfolding of the horizontal range of the two stocks in question, and we can measure the potential upside in the count, the horizontal count. And from that, one's going to have potentially a greater count. And that greater count is going to be the one that's going to be more attractive to us. The one with the lesser count typically is going to be the one that has the less potential for the extent of its rally phase. And so that's typically how we're going to use these two sets of charts differently from each other. We don't want them to do the same thing. We want them to do different things.
Mm-hmm. Okay. If I would ask you a different question, kind of like a reverse question, let's assume that out of these two stocks, as we look at their accounts, they're somewhat the same. Maybe not the same, but in the same vicinity of risk to reward ratio. So then, and this is definitely not related necessarily to the point and figures, but this is something that has been asked. So I really would like in some very simplistic fast ways to address this. So if point and figures is not under the consideration and the counts are the same, what would be the priority for you in the selection process over two stocks, let's say?
Well, it would be how well are both stocks moving up with the market. Let's say we have a bullish bias, or we're looking to be long these two stocks.
Mm-hmm. Okay. Yeah. So you're looking at the synchronicity of how the stock is moving with the market. Is there anything in particular that you're looking in terms of that movement, outperformance, underperformance?
Well, there's a few things that come to mind. One is that you want to look at how well each, say on a daily chart, each daily bar, how easily does it move up? How wide are the bars? What is the result that comes from the effort of volume? Is there an extreme amount of volume with a minimal amount of movement? Or is there an ease of movement to the upside, big wide bars closing near the highs, and volume expanding, but maybe not aggressively expanding, just every day is expanding as the stock is showing bullishness in the way that the bars are expanding. One stock versus the other could could be moving more easily.
Mm-hmm.
One stock could be showing potential relative strength to the other stock. Mm-hmm. It might have a series of higher highs prior to the current move versus the other stock, which may have equal highs in the trading range, or maybe it has lower highs in the trading range. And so the stock that has the more bullish characteristics. The other thing to look for is once a stock breaks above a prior peak in the trading range, and let's call it an accumulation area, when it breaks above, does it resist going back into the accumulation area? Does it stay up there and do what we call a backup to the edge of the creek, or a backup action? And so does it show the ability to be able to stay out of the range? Maybe the other stock has trouble getting up to its prior peaks, and then it moves more easily back down into the range again. And so those are things that we want to compare one against the other. And so the one that's showing that relative ability to be able to move easily, get out of a range, stay out of the range, move on good volume, maybe, but not excessive. It's all we always want to be, especially if excessive volume comes at the top of the range. Because when a stock gets to the top of its trading range, its natural tendency is to go back into the trading range. What we want to see is we want to see stocks that prove themselves by being able to get to the top of the range and then pop out and do it really relatively easily compared to its prior peaks, and then stay out.
Okay. So what I'm hearing from you is that you would look at how the stocks behave based on the price and volume action. You would compare
and compare them to each other,
and to the market, and possibly
and to the market. Yes.
to the market, possibly to the peers in the same industry group if you're comparing.
Right.
Then you talked about a relative and comparative strength. So just looking at the outperformance, again, of the price movement compared to the market, to the industry group. And then you also...
This is one of the most important things that a Wyckofian can learn, is to develop an eye towards looking at two stocks that are rallying with the market, and you look at both of them and be able to discern which one is acting better. Looking at two stocks that are correcting with the market and being able to discern the little nuances of how a stock is pulling back with the market, or its inability to pull back with the market, which is bullish. And so these are the things that we want to just endlessly practice, is being able to make those discernments between, you know, these relative waves of performance. Is to look for relative strength in the way that a stock goes up, look for relative strength in the way a stock resists coming back down.
Okay. You also have mentioned a little bit about structural analysis of the stock. So where the stock is positioned currently in the trend. Is it in the non-trending environment, meaning it's in consolidation, or is it in trending environment, and where exactly it still could be early, you know, phase D, phase E, or it's already in the established trend, and so on and so forth. I also heard from you that...
By the way, I want to toot your horn, because as a former student and now a great teacher, you do some of the best work out there on structure.
Well, thank you.
And
and also I heard that you talked really quickly about your reference to the market activities. So we need to understand the market environment, right? So where are we operating? Is this an uptrend? Is this a downtrend, consolidation, and so on and so forth?
Very important. And then also, where's the market in its own structure?
Exactly. Yes.
Yeah. So is it at a place where ideally we want to time our stock selections and our stock purchases so that they coincide with a market that's at a point in its structure where it's ready to come out of that tension that's the trading range, a stepping stone reaccumulation, for instance, or an accumulation phase, and is ready to jump to new highs and start to move again. That's one of the most exciting times in markets. They come once or twice a year, if you're lucky, and when they come, you want to be on the best horses that are already leading the race. And so the whole idea of market structure, and then having the best stocks when the market's ready to go from quietly moving in its place to jumping to a new place, is where a Wyckofian is doing their best work.
All right. Awesome. Okay. And I think this would cover the selection process. I mean, you and I, we talked a lot about, you know, another category here, and something that, you know, obviously you've done a lot of work on, and I'm working on this a lot right now. And whenever we go through the stocks and we see that the candidate falls into all of the positive signs of, let's say, accumulation, or, you know, we see in distribution, we want to confirm this idea with the peers in the industry group or in the sector. So some kind of industry analysis would be also appropriate at this point.
Yes. As a matter of fact, I think that's one of the best organizing principles that you can use in markets, is to use industry group analysis, sector analysis, sectors which are the broad sectors, and then industry groups which are the typically 100 to 200 industry groups that represent the broad market, is to look at those for their relative performance in their structure, and then from that, choosing the best industry groups, you go in and pick the best stocks and the best groups.
Okay. And Bruce, one of the reasons why I point to the industry group analysis is because we quite often are going to be drawn to stocks that are going to outperform. So their relative strength is going to be, quite substantial. This stock is going to be in the news. This stock is going to be in something like IBD 50 list. So it's going to have a lot of publicity, and primarily the trend is going to publicize, how popular the stock is. But sometimes at the top of the industry group, we can find those stocks. And what I see from the industry group analysis sometimes, you go to the group and you see that it's that one stock that is just outperforming and everything else is just lags. There's no really follow through. So I call, this confirmation a thematical, let's say, buy program by the composite operator. So whenever we see that the whole industry group is improving in the ranking and, the stocks within that industry groups are improving, that's when we want to step in, and it gives us more confidence, to buy a specific selection. Is that the way how you're looking at that as well?
Well, you always want to own the stocks that the composite operator is campaigning. And it's a bit of a paradox in that typically the composite operator is going to be in the best stocks in the best groups.
Mm-hmm.
And but there's rotation that occurs, and rotation can be seen in industry group analysis, where groups that prior to this point in time have been laggards.
Mm-hmm.
And then all of a sudden there's a change of character in the market where all of a sudden the laggards start to behave better, but they're behaving better, say, inside of a stepping stone reaccumulation, where all of a sudden, almost imperceptibly, they have relative strength where they didn't have it before. And they might not be the prior trend's darlings, but they're the stocks that are potentially going to be the next phase's darlings. And so we always want to be aware of rotation,
Mm-hmm.
because rotation is a constant occurrence in the market. So I like to think of it a couple ways. One is that we do want to focus on the leadership. We always want to be focused on what stocks are leading, and especially when the market gets quiet, and after it's been moving for a while, it gets quiet, is that we start to pay attention to the prior leaders. Sometimes the prior leaders in a trend are the ones that have some of the biggest corrections. And so they have the biggest moves up, but then they have big corrections.
Mm-hmm.
And then all of a sudden, everybody avoids them. And they avoid them, and they stop paying attention to these stocks. And by doing that, they are potentially costing themselves a great opportunity, because particularly growth stocks will reach a point where they have like a mid-course correction. They fumble in their earnings or their sales or something. All of a sudden, Wall Street becomes disenchanted with them, and they start to correct. They may have 30, 40% corrections, but these stocks are still have growth characteristics. And oftentimes the CEO will pull their support for the stock, which allows it to fall more. And what this does is it puts the CEO in a position to be able to start to build a larger position in the stock. And so they had a position in it, and now they're building a bigger position. And
Mm-hmm.
an example of this might be the recent correction in Netflix.
Mm-hmm.
Netflix, which had a huge run-up and then had a massive correction. And then it got reaccumulated and then had another move up. And so that's a dramatic example, but there's many of them. So all I'm saying here is that when the markets pause, it creates great opportunities to be able to accumulate stocks that are maybe have rotated out of favor, that are getting ready to rotate back into favor. And so there's trend trading, and then there's momentum trading. Momentum trading, which is very popular, is to look for the stocks that are leadership that are breaking out. And so, I have no problem with that, but there's a whole nother approach to this, which is the stock that is currently out of favor that has the potential to rotate back into favor.
Mm-hmm.
And so both of these characteristics are important, and Wyckoff addresses them both really well.
All right. Okay, so we've talked about all these 5 elements right here. So would it be fair to say that, after all of this analysis, then we can look at the point and figure counts and just to assess the candidate for, the causality that has been built, in either direction?
Yes. Point figure is going to help with all this. And if you have the proper structure, you're going to have meaningful counts.
Mm-hmm.
If the market has built up a potential, you'll be able to count in the market itself. You'll be able to take point and figure analysis and be able to count a major potential in the market through point and figure. You
Mm-hmm.
can do point and figure on industry groups. I have many examples of that. In industry group analysis, point and figure works really, really well with it.
Mm-hmm.
So it goes on and on and on. It's a useful tool with everything we've talked about.
All right. Thank you, Bruce. Okay, so we just went through kind of like all of the steps that we would use in our selection process. And the reason why I wanted to do this with Bruce is because there was a question about, well, how do we actually select stocks? And where point and figures are going to be helpful in this process. So we wanted to show that, well, first of all, selection process is not going to be, let's say a quick or very simple, process. It's going to involve different aspects of the methodology. And I think that the best way to address this type of questions, obviously, would be in a different class, in different environment where we're specifically talking about, let's say supply and demand, relative comparative strength, structural analysis, and so on and so forth. So for those of you who are interested, and the majority of you have already, either taken some of the classes or you've counted our teachings, on these subjects. We literally have this series for almost each of the aspects of this selection process. So the most beneficial would be just to take those classes and just to dive into the details, nuances of how do you actually do this. All right, Bruce, I just wanted to, from the beginning to address this question. I think it was an excellent question, so we're happy to address it. So thank you so much for your input here.
Well, and give some extra thought to everybody to the idea that you have 2 charting tools here.
Mm-hmm.
And so you have the vertical charts, which you can apply to all these markets, and then you have the point and figure charts, which you can apply to all these markets. And you want them to do a different thing. You want them to complement each other with different strengths. And so you can do really excellent relative strength analysis, comparative analysis with vertical charts, and you can do great work on potential extent, how much fuel is in the tank with point and figure charts. And if you just sort of use them in a complementary fashion, you're going to be in great shape.
Mm-hmm. All right. Awesome. Great. Thank you, Bruce. All right, let's go to our material for today. Last time we started talking about Wyckoff count guide, and we went through a couple of steps. What we've done is we said we want to look at this case study of Apple, and we want to look at different counts here. Primarily these two counts, conservative and regular count. We wanted to locate those counts first on the vertical chart as per Wyckoff count guide, and we've located last point of support right here and a potential another last point of support right here, or backing up action. And these were the two lines that we would look at on the point and figure charts as to where we would take the counts.
Go back to that prior chart just for a sec, because this goes back to our prior conversation, is compare just to itself. Go back to November, and you can see from the low to the high, you can see that the move had a lot of congestion and it only had a couple of good up bars throughout the course of the whole move from the low to the high. And then at the spring over here in January to the high, you can see that this move is structurally a much more productive move than the prior up move in the trading range. And this is exactly what we were just talking about. And so you can see that the bars, there's not a whole lot of overlap bar to bar as it goes up. And the consolidation is literally 3 bars, with the third bar being an up day. And then you had another very easy move up to the highs. But at the top of the trading range, we always expect, we always ask the question, well, how's it going to behave up here? Is it going to come back down again? And so you can see here that it comes back down, and it comes back all the way back to the pretty much the bottom of the trading range. So the next move up, it doesn't make a new low, but look at this next move. Look at these beautiful big bullish bars as it's going up. And the volume on, you can see the green bars below. You can see that the volume is expanding, but it's not excessive. And so you have ease of movement without needing a lot of volume, but generally better volume, pushing the market up and then out. And then as you get out, those last 2 arrows that Ramon drew, look at how once it's out, it just rests. It doesn't want to go back into the trading range and go back down again. And that was what I was trying to describe about a chart a few minutes ago in that whole discussion about structure. And so these are the things that we're going to develop an eye for in our analysis. And I know that many of you have taken classes from Ramon and you've done this analysis, but this is just a classic example of a D phase turning into an E phase, jumping out and starting an uptrend. So this is just a good example of what we were just talking about.
Mm-hmm. All right, so let's come back to our point and figure discussion here. So the first on our count guide, as we said, was to locate these count lines within the trading range structure, and then to find them on the point and figure. So in this example, we have 2 charts, $1 box per $1 box size and 1 point reversal and 3 point reversal right here. So, and they both are going to be $1. I believe this is, I think this is bullseye, right? I recognize this. So they actually have different scale here. So I just want to make sure that you guys see this. So this is a $1. And then once we go above 100, it's going to be $2 per box. So this is something that we're going to talk about today. We're going to talk about the mixed scale. It's coming next. But basically, on the 3-point reversal chart, we might not see a specific count line, like we found one on the vertical chart. So we would either have to go to the vertical chart or to 1-point reversal and just to find those places, and then just take the count from here. When we are going to take the count, and this is just a quick review of what we've covered last time, we would want to identify the maximum objective, minimum objective, and also put a 1/2 of that area as a potential, stop in action for the price. How would we derive this maximum, minimum, and 1/2 points? We would look at the actual count line as the maximum objective, and we would calculate all of the boxes, columns here with the boxes. In this case, they're going to be with the different scale mix, and then we're going to add those columns to the count line. In this case, it's 104. And depending on the reversal, in this case, we have times 3-point reversal. Then we're going to multiply the number of columns by the box size, and then by the reversal, and then add the count line to that. And that's how we would arrive to the objective. The same we will do for the minimum objective, with the difference only that we're gonna take the same count from the lowest point of the trading range right here. So this is where our count would start. So we're still gonna have 168, and we're just gonna project it from this count line right here, the lowest point of the trading range right here. And in between, we're gonna have our 1/2 point, and we're going to show it here in the trading range, and we're going to project it the same way. So there's going to be a maximum objective, minimum objective, and then 1/2 of the range. Bruce, can you add anything to this?
The half is important for a couple of reasons.
Mm-hmm.
One is, and we look at the halfway point on a vertical chart too, because think of the objective of the composite operator as they're accumulating their position in this accumulation range. Their goal is to accumulate their position at the midpoint of the range, meaning the halfway point. So their average costing, their goal is to average cost their position at the midpoint of the accumulation range, or at the midpoint of the stepping stone reaccumulation range. And so we would actually look at that price level and say, this is where the CO is building, is their average cost for their entire position is this midpoint. The other part is, Wyckoff always talked about the halfway point in the accumulation range as being an important level, because when a stock runs up to the top or through the top of the accumulation range and then pulls back, he never wanted to see it pull back more than halfway. And so the less it pulled back, the better. And halfway was sort of the maximum amount that he would want it to pull back. So this comes up over and over again in tactics.
Mm-hmm. Okay, couple of questions on this slide, and maybe as a quick review here. Why did you use 153 instead of 168 right here on conservative count formula example? 153 is the count from this point up to this point right here, and then 168 is the count with additional columns. So one additional column is going to be here, and please remember that we're going to multiply by 3, and then we have 2 additional columns right here, so the count actually goes to this point. So naturally this count is going to be larger than the one at the support level. And then another question, and Bruce, I'll need your help with this. If the point of entry is immediately after phase C spring, how can the count at that point be used, since that is the best way to enter instead of waiting until the sign of strength or backing up action to confirm and count then? I think that the question is about this point right here. So if we are assuming that this is a potential spring at this point, our count would be up to here, into the area of the climactic action. So I think that the question is just asking, could we use this count right here at this point of the spring, if we can recognize that this is a spring, and maybe with the potential point of entry somewhere here, and would it be useful for us right here at the count to initiate this position? And maybe we can transition, Bruce, to the definition of the hurdle rate that you talked about last time. And maybe you can spend some time explaining that.
Sure, because at that spring, this is all we know. We only know where we are. We have a break to a one box, 1 point new low from the prior low at the spring. And of course, we would confirm this with the vertical chart. But at that low, that's all we know. We don't know anything to the right. And so we just take from that point and count over to the selling climax, which we've already identified. We know it's a selling climax because of the way it went down, and then the way the automatic rally took it back up and created a trading, the boundaries of the trading range. So now that we know that, we count from there, always from right to left, and we count over to the selling climax. We get a count, and that count, which is this a one box, or this is a?
This is a $1 per box 3-point reversal.
3-point reversal. So 5, 10, 15, 20, 25, 27, 29, and so we have 29 times 3. So we have 87 points of upside potential from that spring, and that spring is at $79. So 79, we add that, and it's 166. So we have a potential for 166 from that low. And so we go the hurdle rate, because we would put our stop somewhere below that spring. Say it's 3 points. So we know, here's another thing we would do. So we'd say the minimum objective that we have for this trade is to get from the spring to the top of the trading range, which is about 104. Mm-hmm. So we can see
even,
the prior peaks.
Even higher, Bruce. I mean, at this point right here, we're still assuming this is an automatic rally, right? So we might be thinking that this is a resistance right here.
Well, I'm always like, I always
more conservative right here.
Most conservative. Can this trade work out, even if it's I'm way early in this trade? So you can see the prior peak before the spring is 104. So you say, okay, I've got a potential to go to 166 just with the count I have, and I have a potential to get from 79 to 104 to the top of the trading range, at which point I'm going to have to make a decision about whether or not I'm going to maintain my entire position, because we still are in a trading range. And so sure enough, this thing comes all the way back down to $83. Now, we never get back to our entry. We maybe get back to our entry price if we buy on that first column up of the X's, where the box that Ramon drew. So if we bought in there, we're getting back to break even on our trade. And so, but the thing is about that is that our stock is acting much better than the market. The market was continued to break the new lows, while Apple was making higher lows. And so the structure of Apple was better than the structure of the market. And so we would look at that and go, if this is an LPS here, this is our next opportunity to add to our position. So maybe we took something off. Maybe we took off a half of our position at 104 area, and then we had it come back down again towards the bottom of the range. Market crashing to new lows, Apple's making higher lows. this is a great place to add to our position. And so maybe we have our whole position on, maybe we don't. But this would be a place to add or to initiate.
Definitely. A couple of points here. I totally agree with Bruce that, you know, we definitely have to think about what is our risk for this trade right here. If we're identifying this as a spring, you know, this is definitely going to be probably the most conservative way of thinking where the price can go. And if we have at least, you know, 3-to-1, and how would we look at this? Well, let's say that if our entry is going to be here somewhere, and I just wanted to go a little bit more, Bruce, into the details of this. So let's say that we are buying on the short-term breakout out of this spring, and let's say at maybe 83. And our stop loss is 1 point below the lowest point, which is 79, so 78. So 83, stop loss at 78. So we have 5-point risk for this potential trade. And we are looking at 104 as our first target. So we see that the price can travel from our point of entry what is it, 21 points. So we have the reward, 21 points, and our risk is 5 points. So our reward to risk ratio here is going to be 21 divided by 5, so about 4 multiplier of 4. So it's above 3-to-1, and this is, you know, is going to be our preference to have that ratio. And Bruce is going to extend this and, you know, introduce this, you know, different semantic here on risk reward ratio. But at this point, we're thinking 4-to-1. It's a great trade for us. And this is just target number 1. Potentially, if we're looking at this as a automatic rally, if we are in true phase C, we might experience a very substantial move to the upside in the sign of strength. The price can continue up, you know, above the resistance. We don't know that it's going to reverse necessarily here at this point. So our target number 2 might be even higher, you know, considering that the resistance was based on the automatic rally. Plus, we know that the sign of strength should commit above the resistance points, about the resistance clusters that the stock has developed, and then start resting. In this case, it didn't happen this way, and that's fine, you know, and you're going to have those type of trades, and you should be okay with those trades. I actually consider this a good trade because there is a lot of solid logic behind this point of entry and how you actually, you know, conduct your trade management. And if the move does not happen in the way how you wanted it, you always have an opportunity, as Bruce said, to either scale out or to get out completely. In this case, scaling out would be better because Bruce has mentioned that structurally at this point, the stock had a much more preferred structure. It was much stronger than the market. So that just gives us a logical conclusion that if you want to eliminate, you know, the risk of the price going and revisiting the support area, probably scaling out would be a better decision rather than just closing out the position. But even if you close the position, you still have plenty of time to enter the position back in this area right here. And this trade on the short-term failure right here is going to produce you a small win, but it's not going to be a loss. It's not going to be a substantial loss. So from this perspective, I really like, you know, this logic right here. Bruce, can you talk about risk-reward ratio and the hurdle rate? What are those?
Well, you know, I think of the hurdle rate, and this is kind of a personal thing.
Mm-hmm.
Is it 3-to-1 reward to risk? Is it 4-to-1? I think that you have to decide on what the number is, and then say, I'm only going to take trades that I can demonstrably measure as being at least 4-to-1, for instance. And so in the case here, at that spring level, you know that from your analysis that at that spring, if you just get back to the top of the trading range, and we always have to be prepared that when we get to the top of a trading range, that we're going to go back into it. And then what Wyckoff would do is he'd say, you only want to go back down halfway. And so this one went almost all the way. It went back to the selling climax level. And so it went through the selling climax level. And this was acting better than the market. Now, one thing to keep in mind here in terms of context is that everybody thought the world was coming to an end right here. The pessimism that existed in this market at that time, in my career, of all the times I've seen, the pessimism was the worst I've ever seen. And people weren't concerned about, they were waking up concerned whether the market was going to be open and trading, whether or not there was going to be a failure of another big brokerage firm. I mean, people, the last thing on their minds was to buy stocks. And these are where Wyckofians have to step up and say, what's the evidence? These stocks are acting better. This one's acting better than the market. The market's making new lows, and this stock is not. It's making higher lows, and so on. And so it takes, you really have to steel yourself in these times. And so in a situation like this where you take the stock from the bottom to the top of the range and you can measure, if I can get this stock to 104, or let's say it's a sign of strength and gets to 106, and then still turns back down into the trading range, I have a 4-to-1 hurdle rate. That it exceeds 4-to-1. It exceeds my objectives. I'm taking this trade. And, my hat's off to you, because you're taking a trade when nobody else wants to trade the market. And so this was a very scary time, and you're stepping up and you're trading the spring, which is like one of the hardest things to do. And so that's a hurdle rate, is when you can measure. If I can just get to 104, I've got to count the 166. If I can get to 104, I'm going to take part of my trade off. Well, I'll tell you what, the composite operator at the top of a trading range like this, top of an accumulation range, this is exactly what the CO does, is they're average costing their position at the midpoint. But what they'll do is they'll put 3x or 5x, they'll put X number of shares on at the bottom of the trading range. It goes up to the top, and they stop buying at the top, and they may actually sell a few shares at the top. So they may buy 5x at the bottom and sell 1x at the top. They might buy 5x at the bottom, sell 1x or 2x at the top, and on balance their position grows and grows and grows. Because the thing that the CO does not want to do in the accumulation range is to buy stock and run the stock out of the trading range before they've gotten on their entire position. And so the CO is always looking to accumulate in the bottom third to bottom half of the range, and they're willing to sell a little stock at the top of the range. And that's what causes the top of the range. That's what causes the stock to stop there and turn back in again. And the CO is not remotely concerned about the fact that the stock's not running up and running out. They're just there. The longer it can stay in that range, the more time they have to get their position built. And so this is there's a lot of tactics at work by the CO, and all we're doing is just trying to emulate them to some small degree.
All right. So as you're talking, I'm hearing that the hurdle rate, and I'm just going to translate this really quickly, is basically our reward to risk ratio, right?
Right, and we would measure that with point and figure, and in this case, we actually looked at the volatility of the trading range itself. And when we're looking at this and we see the volatility of this trading range going from the bottom to the top and back to the bottom, we see that going on. That all is building up point figure count, because remember, the thing that creates a point figure chart is not time, but volatility. And so we're actively looking at the volatilities as the stock goes up, it goes down.
Mm-hmm. All right, sounds good. All right, thank you, Bruce. So let's just close our discussion on this slide right here. And I think that we have a lot of material today, so let's definitely move from here. And I think this is a really complicated concept that we're going to talk about right now. It's the concept of what Bruce has called mixed counts. I call this different price scales, basically the same thing. And that happens when your trading range is on a specific price number where the price scale changes, let's say from $1 per box to $2 per box. And the question becomes, well, how do we actually calculate, given that, different columns might have different box size? So Bruce, I know that you've done a lot of work on this. Why don't you explain to us how would you deal with this situation? And feel free to use this example.
Well, this is going to sound a little tedious. I'm going to make it as simple as I can. And this there are many point figure charting services that do scaling. Like it's almost like arithmetic versus logarithmic scaling. And this is the way that they do it on a point figure chart, is they don't do a log scale, is they actually, when they hit certain price points, they go from, say, $1 box size to $2 box size. And so you're going to see this a lot in the point figure charting services that you might be using. And so I came up with a counting convention that that I developed because I saw a lot of people take different approaches where they would just sort of try to average. They would try to average things because they weren't getting good counts, and they would do other kind of crazy methods. And I thought, this is just not accurate enough. And so I sat down and came up with a set of rules. And we started using them, and through trial and error, we've discovered that this is quite accurate, and it makes a lot of sense. But the first time you hear it, you're going to go, wow, this is like really complicated. But what we want to do is remember that if it's $2 a box, say over $100, and you have 5 boxes, you have 5 columns, the way you would count that is it would be 5 columns times 3 as in 3 box reversal, 5 columns times 3 times $2. Okay, so that's how you would count, get a price objective. So I'm using just randomly using 5 columns. So when your stock is trading through, say, $100, some of the boxes are over $2, some of them are under. Some of them are $1. So how do we accurately get a count on when you have a mixed count scale like this? And so the first thing I would do, Ramon, is draw a line right across $100, all the way across the structure. There, okay. That would be the first thing I would do, is draw a line across there. And everything that's over the line is $2 boxes. Everything below is 1. And so this is what we would do. Is the way I do this is that you go across and you count all of your columns. And so let's what's our count here across?
104 line right here. So we are counting from 1, 2, 3, 4 from this.
Okay, so we're going to count 5, 10, 15, 20, 25, 30, 35, 40, 44, 45. There's 46
columns. Okay, and this is very interesting, Bruce. At some point, just going to stop you to address one of the questions because it relates to this count. So I'm just going to read this question so that we would, as we go through these calculations, we would think why this is happening. So the question is, could you please show how you arrive at 168 right here? 168 means that there are 56 columns, and we just calculated the number of columns as 46. So it's going to become very evident how we actually arrive to this number right here, 168. Okay, Bruce, so we have 46 columns.
So we have 46 across, and so some of them are at 1 and some of them are at 2. So here's the logic that I use for counting a mixed count. So this first column here, we can see that it's above, it's all $2 boxes. And so $2, I'm way over on the right side. I'm at the climax. I'm over at the left side.
Okay.
Yeah.
Mm-hmm.
Yeah. So that's a 2. You can see that there's a 2 up here at the top.
Okay. The first, second, third 2.
So then, well, I started with the first column that we counted, which is down, and that's all 2s.
Okay. Yes.
The next one up is all 2s.
Mm-hmm.
Is the next one down is 2s, and it goes all the way down into the 1s, but we count it as a 2 because it turned down. It was a $2 box size when it turned down, and it continued to go down when it became 1s. It just kept going down. So it took $2. It took a $2 box size reversal down. So we count it as a 2.
Mm-hmm.
Now the next column turns up, and it's a $1. It's $1 box. It turns up. We count that as a 1. So we have 1, 2, 3 $2 columns, and we have one $1 column. Okay, and so that goes up to 100, and then we turn down again. And actually, Ramon, this is an important point. It should be 1.
Mm-hmm.
Because look, it's 100, and this is the way you check yourself on this. It's at 100. The next box down, the next grid down, is it 100 or is it 98 or is it 99? Well, it's under 100. So these are $1 column, $1 grids. So the next one down is 99. So that's a $1, that's a 1 point change. The next one is 1 point change up. But now look, the next one is in the $2 area. So it's one box down takes $2. So that's a $2 size. So now, the way that we do this really fast, so I'm sort of going through this, box by box, but let's just go through and let's just count them. We have 46 columns that we're all going to count as 1s. What we want to know is which ones are 2s, and then we're going to add some extra boxes, some extra columns for that. So we have, starting here over on the left, we have 2, 2, 2. And we look at all the down columns. So we have a down column over here, 2. So let's see, that's 1, 2, 3, 4. And then we get all the way over here, 5. Then we have to go all the way over here to the next 2, which is 6. You see that?
1, 2, 3, 4, 5, 6, 7.
7. And so we have 7 columns to add. So 46, that's 53. So what we do, because it's just like adding 7 columns of 1s, it's 53 now, and this is 3-box reversal, so we multiply that by 3. So 159.
Mm-hmm.
So
Yes. So I was mistaken here with a couple of columns right here going from 100. So
those are really good. Those are really good examples because these are the ones that always throw us, Ramon.
mm-hmm.
Is that it's always the ones that are right at 100 or right at that point where the reversal takes place, because you have to ask yourself the question, okay, it got to 100 and now it turns down. Is it turning down to 98 or is it turning down to 99? And it's turning down to 99 because 100 is the threshold, so 199, so it's a 1-box reversal. And so that's always what we ask ourselves: is it turning down $1 or is it turning down $2?
Mm-hmm. Okay.
So all we do is, if this just takes practice. It just becomes a rote thing. You just the more you do it, the easier it gets, and you draw that line across your threshold, and then you just start looking for all the down moves, which are it's all the zeros are the ones that are going to turn down from a $2 price point typically. So there's one column here that turns up at a $2 level, which is the second one from the left. And you can see it's easy to count that. So you count that as the first one, and then from there you're looking at all the down moves that go below 100, and those are all 2s.
Mm-hmm.
And you just add those. You add those to all the columns across. 46 plus 7 columns, 53 times 3, and then that gives you your count.
Mm-hmm. Okay, and there are some questions that are just suggesting why not do this or why not do that. I want to say that, however you can count this, it's up to you. I mean, arithmetically, you can do it in a different way. I mean, Bruce has just showed you how he does this, and I think it's an extremely effective way. I'm probably complicating things for myself, so I like to count, first of all, just to identify the value for each column. And you see here the 2s and the 1s. And then as we count from the right to the left, I would say, okay, well, how many columns of 1s do I have here? So I would have 9 columns of 1s with the reversal 3, so that gives me 27. So I know that this area right here gives me a count of 27. Then the next column that I have is 2, the value of 2, so I have 1 by 2 with the reversal of 3, that's 6. And I would go through all of these columns like this, and then would arrive at the total. So you can do this. This is obviously a little bit more complicated, and you can do other things. But the key here, of course, is just to recognize that in the areas where the scaling is going to change, that you have to do the count correctly, and therefore you have to incorporate different scales here. And we will show this as an example in our Apple's case study. This is one of the times when Apple had this situation. We'll show you 2 more historical examples and most recent stepping stone where this happened and where we had to apply this technique to get to a much more accurate objective. And it will become evident as we go through that case study.
And I've done just a zillion of these, and they're remarkably accurate. So from experience, doing them over and over and over, they work really, really well. And this is a good technique for counting a mixed count, and it will tend to be very accurate. And so better than any other approach I've seen.
Mm-hmm.
And so just practice it. Just keep practicing, and just ask yourself those simple questions about, is it turning down 2 points or is it turning down 1 point? And then just from that, it'll become very clear how many extra columns you need to add to your calculation.
Mm-hmm. All right. Great. Um, so I think that we don't have any other questions on this particular slide, on this particular technique. So let's just move forward. Again, we have.
The other thing that I like to, I used to joke about is that I don't trade any stocks that don't trade any stocks
that
that
are
have
going to
mixed
be.
counts.
Yeah, I actually don't like that either, because then you have to go through all these calculations. It's a tedious job. I mean,
it goes fast though. It goes fast.
yeah, I mean, if you like it and you know, you use point and figures a lot, at some point you're kind of going to enjoy this, because you know, once I got it, Bruce, I thought that I was kind of like belonging to a special club. You know, I was belonging to the club of people who actually knew how to do this correctly. And you know, when people come and they show their point and figure counts, and I mean, the biggest complaint is always it didn't hit the objective, it overshot the objective, or undershot the objective. But then when we start looking at the ways how people actually created the count, how they looked at the count, uh, this could be one of those mistakes, common mistakes that are not.
Common mistake.
Yeah.
And I've never seen anybody else do this. We're the only ones that do it.
Well, I'm lucky because I got education from you and Hank, so you know, I got it right from the beginning. So to me, that was not any different way. But yes, I see that's happening as a common mistake. Yeah.
It's a secret tool.
Yes.
It's our secret tool.
Yeah. All right. So let's jump to the next step in our count guide. And once we have our projections, you know, the conservative count, the regular count, the more aggressive counts, we dealt, if that's the case, with the mixed counts, if it's needed, then we can go into our point and figure phase analysis. Now, the first thing that Wyckoff would think when we mentioned phase analysis is most likely the phase analysis on the vertical charts. And this phase analysis is completely different approach than the phase analysis on the point and figures. Bruce, what's that difference? How would you describe the difference in this two phase analysis?
Well, you know, in the phases in a vertical chart, I think we probably ought to even come up with different terms like segments.
Yeah.
You know, we count segments on point and figure, and we do phases on.
It is somewhat confusing because I mean,
yeah.
It's the same semantic.
Yeah. Mm-hmm. So maybe we'll change the terms, because in the vertical chart, you can see that what separates the vertical chart is for instance, on the climax, you're looking for a rally and a test, and you can see, right, that you're looking for the areas where testing occurs, and then you rally up and you show a characteristic that says that you're, say, out of the B phase trading range, and you're starting to mark up and out of the range, which is C, and then D is that you get out of the range and start an uptrend. Where in point figure counting, what you're doing is, remember, in a point figure count of an accumulation phase is you're counting from the low to the low. So last point of support to, say, preliminary support, or last point of support to selling climax. And so you're always, in point and figure work, when you're counting an upside objective, you're always looking from low to low. And so this is effectively what we're doing here with these phases, is when you go back, you want to count the conservative phases to count from what you believe to be the LPS. It may not be, but the LPS to the first prior low. And that turns out to be the spring. So there's your most conservative count. And then from there, you go over and you take your next most conservative count, which is the count from the LPS over to a secondary test in this phase 3 area. And so what you're doing is you're always counting from right to left, and you're always counting to a prior low. And so you're saying, if the logic of what you're saying is that all the accumulation in this stock took place from the LPS to the prior segment or the segment before that. You're saying this is where the CO got busy and started buying stock. And so that's kind of the logic of these counting conventions. And so then you say, well, you know, the conservative count is to assume that the CO got busy. So the logic here might be like in this phase 3, is that maybe that is the climax. It's a lower low. It came on very high volume. It wasn't the highest volume, but that could have been the place where the CO stepped up and made a good low and started to accumulate shares, was there and not before that. And so we can't ever really know for sure where the strong hands started to accumulate shares. And that's what we're attempting to estimate with a point figure chart. So we go last point of support, which is the low, the final low it makes before it jumps out of the accumulation range and starts its markup. We know that that's the point at which all the stock has been absorbed and the stock is ready for a good markup and a big uptrend. So the LPS, that's the point we count from over to where we believe the CO got started accumulating their shares. And so that's why we count segments, because we can't ever really be sure where they got busy. And so the logic, say in phase 3, where that's a lower low, that could very well be the place that they started. They didn't start on the climax. They started on the lower low that came later. And so, and all we're doing is being conservative. That's all. We're just taking counts that are not the mega counts. And it's always a good idea with point figure charts to just be conservative and say, okay, here's our count. This is our objective, and if we get to that objective, then we'll start to look at the bigger counts.
All right. Okay. Well, I think that let me put the same thing probably in different terms so that we would have different perspectives here. I think also one of the common mistakes that I see in counting and doing the phase analysis is identification of the boundaries for those phases. And the boundaries of those phases are going to be usually defined by, in accumulation, let's say, by the picks in the trading range, and also by some kind of confirmation of the volume reversal patterns. They are not that visible in this instance. And also for me personally, I always look for that, you know, supply signature, even if it's just reflected in the price movement itself. So I want to see the price from the highs near the resistance of the trading range to fail, and then to have some kind of increase of velocity, increase of the spread, preferably with some volume, and to see somewhat of the short-term climactic action, stop-in action, like in this area right here. This is a trading range by itself. You know, I want to see that presence of the supply, that supply can move the price, potential short-term stop-in action, and then some kind of, you know, reversal of the downswing into the upswing. And what's happening, Bruce, as I look through the counts of different you know, traders, is that if they want to combine two phases and make the extended count, sometimes they take the count, let's say, from the lowest point here at the last point of support, and they go, let's say, all the way up to the boundary of this phase right here, phase number 2. So their count ends right here. And then for the combination of 3 first phases, they would go and they would make the count up to this line right here, the boundary for the phase 3 right here. And generally, it's obviously a mistake. How would we explain to our clients and students, that we need to count to the places where the price actually, have some kind of action.
Well, I again believe that I love to talk about the composite operator, because that, even though we call it a heuristic or a useful fiction, this really is how they get their work done in terms of accumulating shares at good prices. And so we know that the lows of a trading range, the lows of an accumulation phase, are defined by the CO stepping in and putting support under the market. So we want to talk to ourselves about what's going on, what's the narrative here. And so we know that the footprint of the CO shows up when they put good support under the market at the bottom of this accumulation range. And so that's the footprint we care about. What goes on at the top of the trading range is useful and important, but it's almost secondary to what happens at the bottom. And so we want to count. We want to look at where the lows are well defined here. We can see they're well defined all the way through. Is that we want to count. We always count right to left, as I said before, but we want to count to where we see the footprints of the CO, which are at the previous lows. And so that's why we count to those lows rather than trying to find a count at, say, a higher price point. Is just count, go right to those lows and make those counts, because we know that's where the CO is stepping in and putting a floor under the stock.
Okay. What about the question of why do we even need the phase analysis here for the point and figures? I mean, why do we have to dissect the trading range like this and then take different counts? What's the purpose?
Well, a lot of times it's because that's as far as the stock's going to go. And that was the point I'd made earlier about, like at phase 3, let's say that that's where the accumulation started to take place. And so taking the more conservative count gives us a reasonable expectation about how far the stock can go. And so, and then the thing that we were always counseled by Wyckoff was, when it gets up to that count, stop, look, and listen. A lot of times what happens, like let's say we count over to that low in phase 3. A lot of times what happens is the stock will go up to that count, and we flag it, and then it goes into a stepping stone reaccumulation, meaning that it gets that far and then it's got to rest. And so if we flag that, we know that that's a place where we can see other criteria on the vertical chart that tells us that the stock is exhausted for the time being, and that it's going to go into a stepping stone reaccumulation and it needs time to rest. And then it builds a count for a bigger move, and maybe that's the move that takes us over to the big count that's at the low of phase 4, which turns out to be the actual climax. And so that happens a lot. And stepping stones are going to be very important to us. We are going to do a lot of work in terms of accumulating shares, and also being patient when we get our stock reaches that objective of at the stepping stone level, and it reaches that objective, and then it needs to rest for a while. Well, we keep our powder dry. We're careful, and we wait, and we don't sell out our position too early, because we have more fuel in the tank. We have a bigger count, and the stepping stone is going to give us a count, and when the stepping stone gives us a count, then we can maybe even add to our holdings for another move to higher prices from there that's going to fulfill a larger count.
And we can add at this specific time, because the point and figure counts in the stepping stone compared to the original count obviously can give us, indication when the price is ready to leave the trading range. And we'll talk about this concept probably next Monday. as I suspect we are not going to have a lot of time today, to touch upon that. Let me quickly also just review again what Bruce have said. We don't know how potentially, despite of the accumulation and building of the cores here, the price actually going to go up, let's say, from this trading range in the uptrend. So we are taking a conservative route and we are saying, okay, I want to see what would be the count for my phase A. And this count could be so small, right, in phase A right here. We might just say this consolidation right here has a potential, for us to produce some kind of rally, which will be for us a potential sign of strength. Then we want to go to the next phase and combine phase 1 and phase 2 and get the count. And again, it's not going to go to this level. I've, kind of like freely put the line here, but it's going to go either up to this low right here, or on the point and figures, we can extend it up to this point right here. And we want to see where potential next stepping stone, where the price is going to stop. It's going to change behavior for the time being and go from trending environment to non-trending environment. It's going to present us with some supply signature, and then absorption is going to happen through the trading range. And the target is going to allow us to identify where potentially at what area we can expect that stepping stone. So the value of the phase analysis is a lot of the value is in the projections of those stepping stone targets for us. And we also can, I personally do this, Bruce, and I'm sure that you also look at this. I like to look at the phases on the vertical chart for me to understand what kind of campaign we're going to have, what kind of uptrend we're going to have, how many potential stepping stones areas we can expect. It just sometimes, in the trading range, the phases are going to be very articulate. You're going to see that there is a lot of congestion in one phase, a lot of congestion in another phase, and then kind of like nothing in between. So you might think that, we might have a stepping stone at some point, and it might take time for that stepping stone to develop. So you kind of have a potential glimpse on what potentially can come in the future. And as we go through the case study, it's going to become more and more evident. So, Bruce, do you have anything to add to this?
I think you nailed it.
Okay, well, great. So then let's just jump to the
I think we'll see in other examples visually what you're saying. I think there's some other examples that are going to demonstrate what you're saying. Yeah.
Okay, so let's kind of come back again to the basic ideas here, because I see through the questions that we need to maybe, Bruce, stop here a little bit and just maybe to spend a little bit, a couple of more minutes here. So the question, why label phase 1, 2, 3, 4? Why not the vertical chart A, B, C, D, and E? Okay, so think of this as a different technique. So for the vertical chart, our phase identification is going to be different. One of the first differences that I always teach to students and clients, when we compare the vertical with the point and figure phase analysis, is that your counts in the point and figures are going to go from right to left. Our phase analysis, structural phase analysis, are going to go from left to right. So that's one of the first differences, So we don't want to put the same labeling of phases. That's why for structural analysis, we're using A, B, C, D, E. And then for point and figures, it's just 1, 2, 3, 4. And please note, phase 1 is from the right to the left, and then A, B, C, D, E is going to start from the left to the right. And then another question, are you saying in this Apple case study that there are 3 potential stepping stones? Well, there are actually 4 phases, potential 4 stepping stones. So let's just go to the next slide and see how we would conduct this phase analysis, how we would start calculating those phases, and where those projections would take us. So on this chart right here, and I'm still showing the mix count right here, and we're going to use this because we're still in the middle of the 100 price scale right here. So on the vertical charts, we identified the boundaries of the phases. So I put them here in green lines. And what we're going to do, if we want to calculate just the phases, we're going to identify what is going to be our minimum count here in phase 1. So I see this as a potential trading range by itself. It's a small trading range. It's a principal within the principal, a trading range within a larger trading range in phase 1 right here. And this is our phase C, and for this smaller trading range, this is the climactic action. So my most conservative count here in phase 1 is going to be this. If I want to include phase 2 into this count, I'm going to still take the count from the point from this point, last point of support, and I'm going to extend it through the border of phase 1, go into phase 2, and I'm going to stop, let's say somewhere here or here potentially, depending on where I see that climactic action. So let's say that we're going to stop right here. So what I'm going to count is all the way across from this column right here into phase 2, but I'm not going to count it to this point, the border. And there is a lot of confusion about this, so I just want to be extremely specific as to how we would do this. For phase 3, we would continue our count and we would go across phase 1, cross the border, phase 2 count, cross the border of phase 2 into phase 3, and then up to this point right here. And this would be our count for 3 phases. And then, of course, the biggest count is going to be into the climactic action. Bruce?
It's perfect. Now, the thing, why these lows are so important when you're counting upwards is because where the green boundaries are, the borders, ask yourself the question, what's going on? Why is the stock declining to the bottom of the range? Well, there's 2 reasons. One is that the composite operator is no longer buying the stock. They've withdrawn their support for the stock, or their buying campaign. They have suspended it, and there's a lot of supply of stock in weak hands, and so they allow the stock and the supply to take it to the bottom of the range. And then once it gets to the bottom of the range, they lend support to the stock by buying shares carefully, and they buy shares on a scale up as the stock is starting to turn back up again. And so that's where they're getting busy. And so we're counting to the place where they're getting busy and starting to lend support to the stock. And so the reason the stock is going from the top of the range to the bottom is because there's still supply evident, and stock is for sale, and the CO is not lending support at the top of the range. They're waiting until it gets to the bottom. So it's the classic place to take account from.
All right. So let's go to the next one, next slide. And here we see that that calculation of the phases. So we're taking the count for each phase, and here are the calculations, and maybe later on when you have a chance, or you watch the video again, or you go through the slides, just go into the count. We're not going to go into the count right now because, we've done this, before. This is going to be basically the same type of count that we did for the mix account here at, around 100. So let's just look at the projections. What do we have as a projection for phase 1, 2, 3, and 4? And our line is going to be 104. So the first projection for phase 1 comes at 137. So it's right here. And we see how the price consolidates in this area. Even though we have this move to the upside, this was the first reaction right here. That was the largest reaction on the wave in the up in this upswing. So this reaction right here is our first initial change of character, which suggests consolidation. And we are very close to this area right here for the potential stepping stone. The second phase right here is not that evident, so there is not a lot of consolidation going on, but still, relative to the last rally that we had right here, out of this stepping stone here, or if you're looking at the largest stepping stone right here, you see that there is a time when the first reaction, larger than any other reactions in this upswings occur. So also a change of character. It's just a small consolidation right here. Then phase 3 is obviously gives us a very nice objective for the great stepping stone right here. And then phase 4 also identifies a very nice target for us for the price to stop and consolidate at this point. Bruce?
Well, just that those emphasize that those stepping stones are very valuable to us, and that we want to evaluate those with the same focus that we put into the accumulation phase. Mm-hmm. Because a lot of times, this is not uncommon, is that we won't identify a stock until it's had its first big trend, big move up. And so we didn't get in the accumulation phase, but then we go back into the accumulation phase and go, well, how big is this count? And we count that and we say, oh, there's a huge count here, much higher than where we are now. And so what I'm going to do is, when this stock is in a stepping stone reaccumulation, this is where I'm going to get busy and start to build a position in it, is in these stepping stones. And so the stepping stones are very valuable tools for us, because more times than not, we're going to be trying to get on board these stocks when they're on their way up, rather than in the basing action, in the accumulation action. Mm-hmm. So stepping stones are going to be very important to us.
Mm-hmm. All right. And one more time, just to come back to the original phase analysis right here for point and figures, just to repeat, because there is a question on the board. We want to identify the borders of the phases are going to be identified as where the price fails near the resistance, and it starts creating a down movement right here. Also, you can have a confirmation by the volume, to identify those boundaries. Now, the counts are going to be done differently. We are not going to count to the end or to the beginning of the phase right here. We're going to identify specific points in the phases where we're going to stop. Okay, just a quick repetition. All right, let's go to the next one. Okay, one of the valuable tools, and Bruce has alluded to this so many times already, is that in the areas where we are resting in the uptrend, let's say, we have the potential to do the counts as well. And for the local trading ranges, we're going to look, as Bruce said, through the structural analysis. We're going to look at the supply and demand confirmation. We're going to look at, let's say, confirmation of the leadership, if the stock is still a leading stock, or is it falling out of favor and it's just going to consolidate for some time in the trading range and then gain that leadership momentum back. But what that does is that we can calculate the causality for those stepping stone areas, and we can project those in anticipation of the further move. And I think that one of the most valuable tools that Point and Figure has with the phase analysis is that our original target, if it's being confirmed by the stepping stone, so let's say I'm looking at the stepping stone in this area right here, and I know that my most conservative count, but across the whole trading range is going to come to 272. I'm going to be looking for the confirmation by the stepping stone to show me the same target. If it shows me the same target, that's a very firm, very strong confirmation that the price might travel to that area and then start consolidating again. So it creates, it's a convincing strategy. And for me personally, this is probably one of the most valuable tools. It's that confirmation. Bruce?
The other attribute of this is that when your stepping stone, when you're counting across the stepping stone, and when the stepping stone count equals your larger count to the higher price. So when your stepping stone here, which is around 200, 195 or so, count, all of a sudden you get a count that takes you to 272. Those two counts match. That's often a excellent timing tool for when the stock is going to get busy and stop trading in its place and is going to start jumping to its new place, which is, in this case, both counts now count to 272. So it's a classic timing tool, and it's amazing how often this works.
And we will talk about this timing tool probably next time, as I'm looking at the time right now. So we'll definitely talk about this timing tool and how we can apply this. Okay, I think that we've covered the phase analysis. I don't see any more additional questions on this, but maybe we will come back at some point to phase analysis. And we're going to go now through the case study, so it's going to become more evident as what we meant by specific concepts, ideas. Okay, so now let's go into the case study. So I'm widely using Apple for different reasons. There is definitely a lot of vast rich content-rich examples that we can find in Apple because it's a very popular stock. So it's not just popular stock with the public, but institutions popularize this stock a lot in their holdings. So there is a lot of elements of the composite operator companion within this stock. And Point and Figures on this stock is working extremely well, and we'll see that. So I put the chart here, and it's a long-term view, the monthly bars here of the whole history of the stock. We can see, and this is on the logarithmic scale, so you can see that the original trading range right here is quite visible, and that was in the 90s going into 2000s. And then we steadily were in the uptrend all this time. Now, on the logarithmic scale, of course, the last biggest reaction right here does not seem so, dangerous, let's say, and so profound, but, it was almost 50% drop in price right here. Also, there was a quite large reaction right here in this area. But in the context of the trend up, these two areas are still reactionary areas, and there are still reaccumulations on the way up. And we're going to see how the Point and Figures analysis are showing us this stopping places right here. And then we're going to discuss also where we are currently with our current Point and Figure counts for this move to the upside. And obviously, you know, I'm just giving you an example of blank point and figure charts here without any labeling, without any projections. And we're looking at the original accumulation range right here, and then at the reaccumulation range right here, we don't see the third one. But look how much more condensed this area is, and especially, you know, with the scaling here, the price scaling, different price scaling right here. And this is pre-split, so when you look at the prices here, it's a pre-split price. 7-to-1 was the split, if I'm not mistaken, on Apple. So you would have to divide the price by 7. Okay, so let's quickly go through the labeling, because this is the first step in our Wyckoff count guide. We have to find those count lines right here. And Bruce, I put the label in here. I don't think that we have to talk a lot about this unless, you know, you might have a different view here on how to label. I think that the labeling, let's say, in the actual trading range would be really difficult because, you know, at the time, let's say if we're somewhere here, it would be somewhat difficult to see that this is a trading range, the price is sloping down at this point. But it's the point and figures actually that brought me to the conclusion that we have to look at this as a whole trading range. And we'll see the reason why. But going really quickly, this is a reaccumulation because the price was going up, consolidating, and then resumed the move to the upside. And within this reaccumulation range, we're looking at the stopping action, first reaction, and this is just my way of how I prefer to label this. You know, whenever we have a shakeout like this, I prefer to start labeling back as if it's accumulation rather than reaccumulation. And we see a very evident signs of the spring action, which is the lowest point below these 3 points here, and then very evident major sign of strength, which commits to the upside, but then fails as the market in 2000 is busting, and the market is taking a lot of the leaders down as well. It doesn't mean that Apple would not continue the move to the upside if the market would actually hold. You know, most likely this leadership that was exhibited in this major sign of strength is probably would continue, and the structure of the stock could have been you know, completely different. The reason why I'm looking at this big formation right here is actually hidden in this chart. So as we look at the point and figure chart for this formation, and we are starting to look at the projected targets, the maximum target across the whole area that we have here is 220. And of course, the way how we would arrive to this target is just going to be a step-by-step process. First, we're going to look into this area when we're going to identify this as the most conservative count for us. And we're going to identify, you know, what is the count here and what is the projection for us here. But then as the price reaches this objective, then we definitely would like to increase the count into different phases and to start aiding those additional counts. The complication here is that this trading range has spread itself in different price scales areas. So we see that a portion of the price here is above $20. So we have $1 per box. Here from $20 to $5, we have 50 cents, the box size, and then below 5, we have 25 cents. So we have 25 cents right here, and then 50 cents in this area, and then $1 here. So, and that's probably going to be the most annoying thing about this analysis. It's just that you have to identify correctly each column. And these are the calculations right here that I performed, through this trading range, considering this mixed counts, and it just gives these objectives, maximum and maximum and minimum right here. And let's just look where the price actually went, and it will become more apparent as to why we had to take this whole count. So the price travels to the upside, has a stepping stone in this area right here, and reaches 220. The price objective was 220. The price actually reaches slightly above 200 right here. So to me, considering that we are operating in this environment here in 2003 in the range of, let's say, from $5 to $10 as our points of entry, potential points of entry. At this point, if you are at, let's say, $9 you're buying, or $10 or $12, it's very difficult to think in terms of the price objective of 220, because you basically, times 20 times 15 times 20, this is what you're looking at as your potential move. So it's a value of the point and figures charting and analysis to arrive at this type of objectives, long-term objectives. In this case, it's a long-term objective. And then as the price unfolds, you're going to have more and more confidence that your count is actually correct. So that's why, when I looked at this whole count, Bruce, and it gave me this objective, and then I looked at, where the price actually went, it made a lot of sense to look at the large trading range rather than just a small formation when you're looking at this right here. Does that make sense?
It does, and this just points out that this work scales. It scales down into intraday data. It scales up into monthly data. It works so well at in no matter what the time frame that you're focused on. And I think back on some of the other examples that we've done, like we did residential construction, the industry group, and it was the same kind of analysis as this, and it just gave these phenomenal counts that were just multiples of what the index was at a point in time. This is more dramatic than that, but it was like, how is it even possible that it could reach to those levels? And sure enough, it with precision, it got to those levels. So this is I think really speaks to the potential of this analysis.
And to me, Bruce, I'm looking at this minimum count right here of 220, and even though the price went to slightly above 200, I think it's so accurate that you are within, let's say $15 to $20 from your target. Whether you're overshooting or the price overshoots or undershoots.
Well, when your count line was around $7.50 to begin with, it's quite remarkable.
It's amazing how it just worked out in this case. And then I always ask myself the question: well, could we reproduce that? With a different trading range on the same stock. So let's look at this reaccumulation range. It's a little bit more challenging. And, we kind of had a view at this trading range from the point and figure count perspective for 2 sessions now. So all of our accounts that we had on this line, let's say right here is the most conservative, and then, a more aggressive count right here. And the largest counts that we get is 272. The price actually went to about 680, 700. So the question here is, what are we doing wrong, Bruce? Or are we not doing something? How can we change that? How can we improve our, counts here?
I'm all ears.
I thought I was asking you. All right. Okay. Well, one of the more conventional ideas would be as the price reaches the objectives, right? So objective number one, objective number two, and it stops. It might consolidate. It might just actually continue the movement to the upside. We just want to see how the price reacts in those areas. Remember that Bruce mentioned this. We are stopping, listening, and watching what is happening with the price and volume and with the market. And those are going to be sometimes areas that are going to be reached and that the price is going to continue its movement in the uptrend. And we're going to be puzzled as to, well, why didn't we have any reversals right there? And the mistake would be to think this way because that the reversal has to happen. It doesn't have to happen. We might go into the stepping stone and develop the new count for a higher objective. So the vertical chart analysis and the selection process that we went through the beginning at the beginning of the session becomes really crucial in those places. So one of the ways to deal with objectives that are being overshot and the price just continues its movement is just to raise your counts to a higher level. So I'm showing here where potentially you can take the next count. So you always want to take the count on some kind of reactions and just go across this area, and this could potentially be your count right here. Personally, it's not my preference to do it this way. I'm going to show you how I do this. But you can get, quite accurate counts from this to objective, as you might see that, first of all, your line is improving. So right here, you're already, at 168 line and not 104. Your scale is improving. So here, you're all going to be in 2-box size. So we're just going to increase the count. You're also improving on the number of columns here. So your count naturally is going to grow. This is one of the ways how you can, have those extended counts in the very, very big campaign. Bruce, is that how you would apply the counts here in this case?
Well, yeah, because when you start to get to those levels of the lower counts and you go to them and through them, you go, well, is there more? How much more is there? So you go back and you look at bigger scale time scales. You look for bigger trading ranges and see whether or not there's more fuel in the tank. And kind of a story that I just recalled was that because we were actively doing Apple in class, and so Hank and I, we would pull up Apple every week and we would update it because it had such a classic base. In real time, we were following it in class, and then subsequent semesters, we would continue to look at it because it was having such a great markup as we went along. And so I showed it to Hank. I'm like, Hank, look at this. It's fulfilled these counts, and look where it is. And he goes, and he'd take his pen and he would like draw across there, and he'd go, look, there's a bigger count and a bigger count, and it's just like, just keep counting, and so that really is what you do. Is when you get to a place, you fulfilled your count, you fulfilled your objective. Is at that point start to look and say, is there more fuel in the tank? Is there a bigger count? Can I look at a bigger scale and see whether or not there's more there? Because sometimes you get on a stock like this and it just goes and goes and goes.
All right. Okay. Makes a lot of sense. And I love when Hank does that with the counts. As I said, for me personally, I would look at this slightly differently. And for those of participants in the sessions who have taken my classes, you know how I'm looking at, let's say, stepping stones. We might have some kind of reaction here, and I'm looking at this whole reaction as a potential trading range, potential consolidation, where it's a part of the major trend right here. So if there is a consolidation where the price is consolidating around some kind of mean here, then I want to look at this whole area as the potential count for us. And this is what we would see. So I would extend the count on the same lines, and I'm saying this is an alternative, so this is not by the book. I would extend the conservative count here as an alternative count to the first area of for the change of behavior, and then a larger count. So I actually calculated these two counts using the whole trading range right here, or this sloping down trading range, or this whole reaction, whatever you're going to call this. So the first objective here, the conservative count, gave me 637, 636 from 84 line. Please remember that this is a pre-split pricing, right? So we're looking at all of this price, and this is pre-split. So if you're looking at the current Apple chart, obviously the pricing is going to be different. And then the second objective that it gave me was 640 and 685 from the 104 line. Now let's see where we landed actually with those targets. So here is this campaign right here. Here's this upswing that we had since 2009 trading range. So this two alternative counts gave these objectives right here, black and green, and I'm just describing what they are. And look where they landed. And we are right at the climactic action here on the first objective, and we are right in the area of the upthrust action right here for this distribution action that just takes us down, in this downswing. So pretty accurate. And also I saw the objectives that were done, using a count like this right here. So they also went into this area right here. I just don't have them on the slides here. But it just confirms that, whatever technique you're going to use, you definitely have to extend your count as the price goes up in the trend, starts creating different stepping stone areas, and then you see that the price is not reversing down. In this area, instead of going down and changing the behavior and indicating that, now we are going to be in the downswing, the price continues up, goes into the next area, continues up, goes into the next area, continues up, and so on and so forth, until it actually comes to our price objectives here, and then it starts behaving in a more distributive manner. All right, so this was the second example, Bruce, right here, with this long-term stepping stone count. Let's look at the more current action. We put really, simple labeling here for the latest original trading range after the down move that we had. So really quickly, just to go through this, climactic action is defined by increase of velocity, increase of the spread to the downside, increase in volume right here. We see how the supply starts to decrease through the whole formation going into phase C right here. And we have our, mandatory test in lows, secondary test in A, secondary test as a sign of weakness in B, and then, a slightly higher low here in phase C. And why this is phase C? Well, a sign of strength actually confirms that that was phase C, and the backing up action here also helps. So that's the labeling for this original trading range. So we're going to look at the counts in this area right here. We also want to look at the counts in this stepping stones and see whether they are going to confirm each of the up movements that we're going to have. We also want to see what are the counts here in the original trading range and where they're going to lead us and how the stepping stones are going to confirm those. Okay, and Bruce, I think that this slide here, we're going to spend some time here, but this is probably going to be the last slide because we're almost, we're actually at 6 o'clock. So, but I think that we should finish this slide. Okay, so here's the labeling on the point and figures that I showed you before on the vertical. So here is this original trading range. And Bruce, we are going to take the most conservative count first, right? So if we're on the vertical chart and we're seeing a potential phase C, let's say in this area right here, and the price starts to reverse, we might assess at this point the trade that we've talked about, the hurdle rate, the reward to risk on this potential trade. And obviously we know where the stop loss is going to be below the lows right here. And depending on where our point of entry, we're going to look at our most conservative count, and we also can take, you know, the resistance points in the trading range as our potential targets here. And we're going to ask ourselves a question: do we have a favorable reward to risk ratio for us to initiate this trade? Would that be a correct, you know, assumption for us at this point and the correct action?
Well, yes, and when we get to the bottom of the range there in that spring, that LPS spring action, that's a place where we would look to initiate an initial trade. And so we have a count that takes us to the top of the trading range and has an adequate hurdle rate that reward to risk, that at that level that we'd say, you know, let's make this trade, let's get on board, and then with the expectation that it can get to that level or through that level and then hold up. And in fact, it does get through that level, and then it has about a 50% retracement, which is normal. That's a normal retracement where we can accept that as a reasonable amount of pullback. And so I think that it makes perfect sense to make that trade.
Okay. Yeah. And instantly, when you see that the most conservative count gives you an objective in the area of the resistance that was created, let's say, by the automatic rally or any other upthrust actions here in the accumulation, it's a confirmation, because you start thinking, what is the next price action after phase C? So obviously we have to go into phase D, into the sign of strength.
That count is, it achieves that count, which goes to the automatic rally. It's going above the 3 prior peaks, which is automatically a sign of strength.
Okay. Yeah, absolutely. So from these point and figure count, most conservative count, we already see that potentially we can develop, if it develops, it could become a sign of strength. And obviously we are glad to see that the price actually overcomes the resistance. It spends time here. It's not reversing as an upthrust action and coming back into the trading range right away. It's one of the recognition points for us to see the sign of strength development. So we want the price to spend time above that resistance. And we can also extend our account right here. And I put this in green right here. And we're extending it into the area of the climactic stop in action. Why would we do this? Well, because we want, again, you know, to test those lows, those significant lows where the price has been supported or started being supported by the composite operator. And we want to see where it's going to take us. And look at this. This second conservative count, which is in green, takes us to this high right here, which I labeled as second sign of strength. So it's if we could say that this was maybe a minor sign of strength or the first sign of strength, this is definitely a major sign of strength. It shows us such a change of character in how the price behaves, making the new higher highs, higher lows. And it's just so accurate as to where it went, how it was projected and where it went, basically within $1. And sometimes, whereas when it happens, it just amazes me so much. How sometimes those counts could be so accurate.
It always amazes us, but we act like we knew it all along.
Yes. Okay. All right. So each time, once our objective is reached, so let's say in this area here for the first sign of strength and for the second one, we have some kind of reaction or a stepping stone. So this is the largest stepping stone right here. This is the first largest stepping stone. So we want to apply our stepping stone analysis and see whether we can confirm any type of objectives from the original trading range, and whether the stepping stone objectives are going to actually confirm the counts from the original trading range. One of the next counts that I have here in the original trading range is on this line right here, 64. And I'm taking this low right here on the backing up action and extending it from right to the left to the climactic action. So the count here is 103. And then in this stepping stone on the backing up action right here, I'm counting from right to left. This was the first element of supply right here, a change of behavior. So I want that count to extend to this point. And it gives me an objective right here. But then after the sign of strength in this trading range right here, and I hope that, you know, on your screens it's quite visible, we have a very strong move to the upside. We are overcoming the resistance. We're committing to the upside. We're spending time above that resistance. It's a sign of strength for us. And then we have in a backing up action, which is not coming back to the trading range. It does not go below the previous resistance that acts now as a support. Instead, the price just reverses and continues to move to the upside. We can take the count from this backing up reaction here. And this count gives us actually as the maximum objective right here on the 56 line an objective of 104. Whenever you see this, when one of the counts from the original trading range and one of the counts in the stepping stone confirm each other, that's a very good sign. And most likely you are going to have some kind of stalling action or a reaction at that point. And look what is developing in this area. We're having a stepping stone, another stepping stone right here. And Bruce, I think, again, to me personally, this is just one of the, value points of using, point and figure counts. It's exactly that, just that confirmation by the stepping stone that we might stop at that point.
Right. And when we, I'm not going to say too much because we're running out of time, but also notice how when you stopped at that point, it came with some climactic culmination. There's climactic action up into the counting phase, up to the higher counts. And so that's sort of, we would expect at a climactic action type like that we would be looking at stepping stone or pausing action, or even the potential for distribution. But in both those cases there, those examples, you have climactic action that stops the uptrend.
Okay. Great. So One of the next counts here on the stepping stone that we have is an interesting case study. I mean, we've talked about the mixed counts. We've talked about overcoming, having a trading range on the, let's say, $100 line. So obviously, some of the columns are going to have the value of 2, and some of the columns are going to have the value of 1 for us. And here, I put this sequence of values for our columns right here. So as we go down, it's 2. As we go from below 100 up, it's 1, and so on and so forth. So for me personally, it's much easier, to do it this way, and then just to calculate. So here is the count for this stepping stone. We have 7 boxes at $1, and we have 8 boxes at $2. Columns here. And then we add those two together, 2 counts, and our price objective is 119. Look at where the price came at this point. Exactly to 119. And I'm not saying that it should be exact, but this is what instance number, let's say I'm still considering this as actually as success here. This is definitely a success, so 2. And then we have 2 targets here projecting 104, 103, and then we have another one projecting this 119. So 1, 2, 3, 4 times in a row, we're getting the correct count here. Now, what's interesting is we do have a much larger count. One of the largest counts here was at this second backing up action right here, and we're going across the trading range right here, and on this line with 62 boxes, we're coming to 133 objective. Here it is, and look what is happening in this area. As Bruce was saying, each time the objective is being fulfilled, there is some kind of climactic action at the end of this move into this target area. And we definitely have a climactic action right here as well. So all of those are going to be our stopping actions where the price is going to first change the behavior and then consolidate. Change the behavior, consolidate. Change behavior, consolidate. Change behavior, consolidate. So Bruce, it's just amazing how all these counts are just working out in this case study. And as we currently go into this area right here, please note that once we went above 100, and this is a common question that I see on the board right now, can the software automatically adjust to the new scale? I personally use TradeStation mostly. I do use stock charts on a lot of occasions, but for the point and figures, it's just easy for me to use the TradeStation. TradeStation do not have that automatic switch, so I would have to go and create a $2 box chart, and this is it. It's 2 by 1. And then I had to look into this area from the perspective of the $2 box. And this count right here just gives me exactly, again, this target. And please note, we want to have that confirmation from different accounts. The original count on this line, this is the backing up action number 2, gave us 133. This action right here, the stepping stone, above 100 at $2 per box is giving us 132. So again, we see for the 4th or the 5th time here in this recent rally that the stepping stone is confirming the original counts, and that's extremely important.
And notice how at that point, as soon as the stepping stone confirmed the base count, right at that point, it jumped out and started to mark up.
Mm-hmm. All right. Well, Bruce, I kind of like wanted to jump a little bit through this whole case study because obviously we are running out of time, but I want you to give us your observations here. What are the important elements here on this chart right here that you would want our participants to look into and maybe to remember, make mental notes?
Well, if I was to, I think just to put a period on this, on the thought, is just that this is the value of using point and figure to campaign a stock. So you're campaigning this stock upwards, and you're doing this analysis as you go. It's an unfolding story. And so you get these counts that take you higher and higher. You're campaigning this, and you're trying to determine where is the end of the campaign. And so it's a little bit late in the day to get into that, but notice the trend line that we've drawn, and you can draw the homework assignment, draw this trend line on a vertical chart, which is the reverse use of trend lines, drawing over the peaks at the tops of the rallies. And so you can see here that as you approach the late stages of this uptrend, you're throwing over the overhead line. You're throwing over that and coming back in again. And then you did it again, and clearly the last two moves have large climactic qualities to them. They throw over the top of that upper trend line, reverse use of trend lines, and then come back in again. And they come back in, and so you can see that that Apple wants to respect that trend channel. And so this, and at the same time, it's meeting the objectives. So this could be a sign that Apple needs a bigger rest. It needs more time, and needs more time to rest. And so it's a little early to be able to say more than that. But it's pretty dramatic how this is unfolding right now.
Mm-hmm.
But this is a campaign. And this is a great example of how to use point figure to conduct a campaign.
Mm-hmm. Mm-hmm. Okay. And talking about the campaign, the question is obviously, first of all, what are we having here? And that's not going to be extremely evident from the point and figures. And we have to go to the vertical chart analysis and just to start conducting, our regular vertical chart analysis to look at the supply and demand, absorption of the supply through the structure or supply presence if this is a distribution, structural analysis, where we are in terms of the phase analysis, what is this right here? Is this an upthrust? And so on and so forth. So that will give us much more information than just point and figures. But one of the things here, talking about the campaign, is that we do have a larger objective here. On this line right here, 75, we have this objectives, the minimum and the maximum. But please note that the minimum objective right here is at 143, and the highest point here is 134. So we were $9 away from that min objective. So it is potential that the price might consolidate and even reverse at this point, and we still would consider that this largest count right here, and we might not even at that point say that this was a valid count, because this count right here and the count from this step-in area right here both indicated 133, 134. We might just have a reversal here. We might just consolidate and reverse. We might consolidate and then go and fulfill this objective. So we still have to wait, as Bruce said, to see the evidence of either supply absorption or supply presence. And if the supply has been observed, then yes, we can use discounts. If we're going to see elements of the distribution, then we have to say that the whole campaign is over and we are ready for the down move. Okay, Bruce, I think that that's it on this chart. I wish we would have a little bit more time, to go through each stepping stone, because there is so much that we can talk about here. And maybe one of the assignments that we can do for the next session is just to receive any type of questions on this slide, and maybe we can start with this slide next time, and maybe to reiterate some of the points.
Sounds great.
Yeah.
It's
okay.
A great case study.
Absolutely, I think so. I mean, and just looking at Apple, the whole history, I mean, it just becomes we are growing this case study more and more. I think the next step is going to be to include, areas of the distribution and look at those, from the perspective of the counts. And I think that we might actually, maybe bring just one example of the distribution, because I know you have a lot of great thoughts on that. And there was one of the questions here. What about down counts for the stepping stone ranges? How would we count those?
Probably you'd have to go in. Well, first of all, with a stepping stone, you're assuming that you're in a trading range. And so what you do is you would look to the bottom of the trading range. And there's a whole art to stepping stones. I mean, we'd do a whole class on them, like 3 sessions. But here you can see that a stepping stone will set a range, and then it'll oftentimes stay in that range and will spring the low, will be the last thing it does before it takes off, which is what happened in September, October. And then other times you get sort of a saucer kind of a thing where it's going through a more sort of traditional accumulation type action. And so you can get both kinds. And on that second stepping stone, we could probably zoom in there and get a down count on the second stepping stone, the one that's in
this one?
Yeah, that one there. We could probably zoom in and get more sensitive data and be able to determine a down count from that. And we'll try to get into that next week.
Right.
Because
I think
we want to spend time on distribution.
Yeah, I think it's a good point.
Yeah.
Let's definitely do that. Show some distribution examples.
Point figure charting works on intraday data, and so we can use intraday data in the same way that we're using the data here, the one box and 3 box reversal data, and so we can take a few minutes to go through that next time.
Okay, sounds great. Okay, Bruce, why don't we go to the questions now and see what our participants here are asking us. Okay, so I talked really quickly about the TradeStation and how it deals with the mixed counts, so going, for the price to be below and above. So it actually does not address this question. But I know, Bruce, that other softwares probably do. Can you point our audience, to those softwares that actually have that automatically built-in function of going from $1 to $2 per box?
Stock Charts definitely does that, and Bullseye Broker, the old version, which is the version I use, I don't think that's available anymore. That one does that. There's some old services that I could try to get some information on for next time, and we can. So there are other point and figure charting engines, and we'll see the ones that I use stock charts, and I use Bullseye Broker. And so we can check to see what the other ones are and how they do their scaling.
Mm-hmm. Okay. I'm actually looking at other questions, and I see that everything is probably a repeat from either session number 1 or today's session. One of the questions is kind of like a basic questions on how do you actually count, and for those of you who are familiar with Wyckoff method, or you just started studying it, but you are not familiar with the point and figures or how Wyckoff actually did the counts on the point and figures, it might take some time. And my suggestion would be go back to the first session. Bruce and we've discussed exactly how we're going to take the count on the specific line, how we are going to define which line we're going to take the count, how we're going to count it, how we're going to count through the phases, how we're going to look at different reversal and how that's going to influence the count. So please go back, re-listen to the videos, and or just look through the slides. Okay, next question. Can the current trading range in the point and figure chart be used for projecting price in Apple? So we are talking about this trading range right here.
It's we would want to go to the vertical chart and look to see. The thing that stands out to me about that chart right now is look at the ease of movement in the decline off that up thrust. So you had a pretty dramatic move down. It moved easily down towards the bottom of the range, but it has not made a new low. So, and you can see here that volume has been expanding and relatively high on the decline. And so what we want to see as the stepping stone is concluding, if that's in fact what this is we want to see volume diminishing, particularly when it's correcting back towards the bottom of the range. We want to see volume actually diminishing, not expanding. So this right now is just very murky. It's not what we would expect to see as prices come off and up thrust and come down, is to have them turn back down towards the bottom of the range pretty quickly and on volume. So that doesn't mean anything, doesn't mean that it's over, doesn't mean it can't go back up again. It just means that before we can have a good up thrust, before we can have a good jump out of this and call it a stepping stone, we should see it get more dull and quiet and have some attempts to go back down towards the bottom of the range, and volume diminishes. That's happening.
Mm-hmm. All right, sounds good. Let's see if we have any other questions. If not, we're just going to stop here. So obviously a lot of material today. And again, the best thing is just to watch the recording again and just to go through the notions of, well, I want to do this by myself, so go through the same chart and just try to come up with the same counts and understand, how to conduct this analysis. So that's probably going to be the most beneficial. And then, migrate to other stocks and, do the same thing and try to see on the historical examples. Don't take the current examples. If you're just beginning to use this analysis, go to the historical examples, identify those areas of consolidation, know exactly what has happened before. look at the point and figures, find those count lines, identify those counts, project them to the upside or to the downside, and then see whether this count was correct or not and where the price took us. So that would be my advice. Bruce, great session. As always, such a pleasure to conduct a session with you. I thought that we've covered a lot of material. And we still have quite a lot of points, to cover next time. I think that we're going to talk about the timing mechanism. We're going to talk about the distribution, and let's look at your case study on the Dow Jones Industrial. And we're kind of going to go through the latest campaign of 2008, 2009 into the current.
Terrific. Well, thank you, Roman, and thank you all for a great session. It's been fun.
Thank you very much, everybody. We'll see you next week at 4 p.m. Pacific. Thank you so much. Bye-bye.